Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Tuesday, June 20th, 2023. I'll keep this one relatively brief. Just do a quick update on the equity markets. Those sell signals are still intact. I'll talk on that real quick, and then I wanted to just follow up on that theme that I've been talking on really for a better part of a year now, that negative feedback loop or vicious cycle between inflationary forces, i.e., commodity prices, prices in general, rents, everything else, the stock market, and of course, interest rates of the Fed. And that's all kind of intertwined here. And the point being that when one goes up, when interest rates go up, that's bearish for equities. And again, it's more of either actual or implied. That's what the market will react on. The market will do its own thing despite what the Fed does. In other words, the market may rally on the expectation of the Fed pause, which it has, or Fed cuts, and likewise once if and when inflation rears its ugly head, or for whatever reason the Fed increases rates, the market's not going to like that. And we all know that's simply because rising rates has a negative negative effect on both the economy and the stock market. Alrighty, so we'll talk about the sell signals real quick. This 60-minute chart of QQQ, as I covered earlier today, and on Friday we broke down sell signal on Friday, solidly confirmed today. The bulls did their best to step in, as they do, especially when you start to turn after such a strong uptrend. You're going to get dip buyers, and then what you look for is if this is just a correction, then I already gave you a correction target. That's what we're focused on right now. But very much open to the possibility. We'll see how things develop going forward, that we may go on to take out those this near-term swing target, about a 6% drop in QQQ, and then open the door to much larger moves. In other words, this could be just a correction with new highs to come, or could be the end of the bear market rally and the beginning of a new downtrend. Only time will tell, but we're going to be looking closely, and that's what I'm going to do in this video, for the things to watch that might give us some advance, kind of heads up or indications which one's going to be. If you look at it this way, you've got the leg down recently, and this would show better on a shorter term chart, like a 5 or 15. We're on the 60, maybe a little bear flagging action there, and that should take us down, if so, tomorrow down around close to that first target there, about 357.70. So again, I just wanted to reiterate the despite the bounce today, you can see these yellow lines right here. Here, we can look at the 1-minute chart. This is what it looks like on the 1-minute chart. They tried hard, but could not completely take it and close the market green today. That yellow line is yesterday's close. So we came back up to that level a few times, reversed. This is what a 1-minute chart looks like. Now, this isn't in play much anymore. We can look at after hours, but this is just what I look for when I'm actively trading, and a little in and outs on NQ and trades like that. So yeah, the uptrend line right here, you still have it. I'll show you the after hour trades in a second, and then pretty much this is what capped it all day here. You had this little ascending triangle pattern, and down here you have some support. So you had this trading range right here today on the 1-minute, and then the uptrend line. Let me turn on the after hours. They tried to hold this up as long as possible. In post market, we took out the trend line, and boom, and this is real time right here, just hit the 366.37, that level. So in the after hour session, or tomorrow if you want to play it safe, if we gap down, or you don't have to gap down, just take that level out, clearly move below it. That should get us going. And that's very short term. That's a 1-minute chart. There's your 60 right there. So that's intact, and we still have the breakdown in SPY intact, the S&P 500. Here, let me turn off the post-market trades, regular hours, just to see how we close. There was our breakdown right there today, and we remain below it. So really nothing more to report other than the sell signals remain intact. S&P closed down 0.52%. QQQ, this is interesting to note too. Remember, for weeks, even months now, we had the sharpest divergence between the S&P 500 and NASDAQ on record, with the NASDAQ grossly outperforming to the upside, and horrible market internals. It was very well, telegraphed that it was just a handful. Those big tech, mega tech companies, Apple, Alphabet, Amazon, Nvidia, Meta, doing almost all the heavy lifting. And then in the last couple weeks, we did see, which I'll acknowledge, improvement in market internals, more and more catching up. And I always say this: one day doesn't make a trend. But if you look at what we did today, the Qs closed down 0.28. Almost all of that had to do with Tesla because of the weighting. Remember, these big market leaders carry a huge weighting. I can even tell you exactly how much right here in QQQ. Tesla accounts for... Oh, no, I have to go to Tesla itself to tell you. Tesla's 3, and that might be higher now, 3.66. So a significant weighting, not one of the biggest, but still pretty significant there. And that was up 5% today. So now here's what you do. You look at this again. Microsoft, Apple, Amazon, Alphabet, Nvidia, and Meta alone. Tesla dropped out, but still that 5% lift, 5% plus lift was a biggie. When you look across the board, you had Apple flat on the day. You had Microsoft down 1.3, Alphabet slightly down, Amazon virtually flat. Nvidia and Tesla were the only two doing the heavy lifting today. So, but here's what I wanted to show you. So now look at QQQE. Well, first of all, QQQ up 0.28%. So not too bad. But QQQE, the equal weighted, down almost 0.8%. And I'm going to use my real-time indicator here. It's to the right of the screen. I'm going to sort my watch list. I have a watch list of all the 100 stocks in the NASDAQ 100. And when I sort those by gainers and losers today, again, I've done this for you before. I just have to float a watch list. I don't have that watch list floating. It's just cut off on the side. Oh, you know what I can do? I can bring that over for you. Or can I? Oh, I have to pause it. There it is. Actually, I didn't even need to pause. I think I just dragged the corners. Right here, you can see. So these are the stocks that closed green today. And what I do is I click there. And you can see on the very bottom, it's so small, 23. So only 23 out of the 100 stocks in the NASDAQ 100 were up today. That means the other 77 stocks were down. That's pretty bad internals. I always say one day doesn't make a trend, so let's not get too excited about it. But it's something to watch. You watch, 2 days, 3 days, and after a couple of weeks, if you see that continued breadth deterioration, then it is typically a bad sign. So that's it. Just want to point out the sell signals intact and the pretty poor breadth. In other words, the NASDAQ would have been down a lot more, and that's why the S&P was down, and a lot of things closed down today. So we'll pick it up tomorrow. Now, on the flip side, if you want to give props to the bulls for anything, you say, well, at the end of the day, let me sort my watch list here. You have Apple still above its primary trend line. You have Microsoft, kind of like I said, meh. That uptrend line is a little bit meh. Maybe I pull it here now, play around with it. I just don't have a great trend line or horizontal support. Amazon still below trend on that uptrend line right there, you can see, but really about flattish. Remember, I did the video today, not much. Nvidia still doing its thing up there with divergence, but still at the well above this or within this little trading range after the gap up. So no, not even close to sell signal there. Tesla, I just showed you, it's kind of earlier today. I told you it's been flirting with this trend line. Still, there's the uptrend line, still above it right now. And then Meta, again, you guys know what needs to happen, and that is a break of the very well-defined trend line. So sell signals on the indexes, but not on the market-leading FANGs. That's the summary today. So not an all-in moment. And at the end of the day, if tomorrow or next week or any time between, the Qs snap back above their trend line, the S&P snaps back above its trend line, they're whipsaws, and that's it. So if you are short, you decide where you want to stop out, maybe above the recent highs, maybe a solid move back above the trend lines. And if you're looking to short or add to shorts, you don't do it if that happens. You do it now if we continue down. So really what you'd want to see for the S&P, you have some support right here. If you zoom in real tight, you can see there's a gap and then a few reactions where you back tested, including one right there. So that should really start to accelerate the selling, in my opinion, for the S&P 500 to break above about 434.80. Get a little support here, probably get a little bounce and then jog down. So that's what I see on the indexes. Now let's talk about. I went over the euro quite a bit lately, and just tell you, it's still closed so far. Still a reaction on my 109.375 resistance. A reaction I define as when you have a straight, a clear trend up, powerful move up. Reaction can either be a consolidation or it's a correction in time or price. So far, it's been mostly time, but it is so far a hit and a reversal off that level. So we'll watch this. I still favor a move down there. If that happens, because of the correlations I've shown you the last few days, I put very good odds. It means stocks down as well as gold and silver down as well due to their positive correlation with the euro, meaning they move in the same direction, just like they move in the opposite direction of the US dollar. So that's that. The only other thing I wanted to cover is the inflation trade, the commodity trade. Remember, lately I've been focused on those three things as far as analyzing where the stock market might go, and that is the euro, the impact that it has, and the dollar, of course, and then commodities, and DJP being my favorite real-time commodity or inflation indicator because it's a very well-diversified commodity ETN. And I've showed you in the past, and I'm going to show you here again, the correlation between commodities and the stock market. So I've talked on that. I've done this more extensively. I don't want to make this a super long video, but I've showed you since this bear market started back in right around the beginning. I have the S&P right here in green. That's where it peaked. Bear market started. So far, by just about every metric, this is still a bear market rally. Time will tell. Some would think it's a start of that this was the start of a new great bull and we're going to see new highs. Others, like me, believe this is just simply a bear market rally in line based on the magnitude of the previous advance and the drop so far. It's in line with historical bear market rallies, not necessarily in percentage terms. Again, in relative terms, relative to the previous moves, especially the move from the top to bottom there, as evidenced by Fibonacci retracements and things like that. Okay, so I have covered in the past that inflation, everything was inflated when the Fed hit the nuclear button back when COVID hit. Printing money, the DC printed money was shoving checks down everybody's throats. Forbearance on, people didn't have to pay their rents. People didn't have to pay their student loans. People were getting stimulus checks and everything. So we all know what happened. And they overheated the economy and they caused hyperinflation. And the Fed started hiking once they finally realized that they were wrong. And it started to work. So after the first few hikes, you started to see commodities fade. And I've gone over this again in detail. I'm not going to do it now. You can do it yourself. That every little, once inflation became a real thing, again, this white line here, the market realized that as inflation was going up, the Fed was going to be forced to raise rates, and that put the brakes on the economy. But then when you had these abatements, finally, this is DJP, the commodity index, you started going down. See, we were in a bear market. Inflation was still going up. Commodities prices were going up. Then your first big drop. The markets loved it. They rallied. They say, hey, those rate hikes are working. Then we had a pretty decent rally in commodities, and oh no, it's not over yet. So you see, and I did this before, very strong correlation. But then it became, other than these little corrective waves, after a while, drops start to form a trend, and you could clearly see the white lines that there was a downtrend, which again, I've covered this in detail recently, I view as a corrective wave. Again, normally in line, relatively speaking, to the previous wave up, downtrend lines. Every other thing I've covered shows me that this is most likely a corrective wave, regular Fibonacci retracements within a larger bull market, and there's going to be another leg up, quite a few in commodities in the coming months to years. Now, whether it's over or not will be yet to be seen. So what happened recently is we started to get these little spikes up in commodities, and the market was less responsive to it. It did, and there is a lag time because inflation numbers, and this is something I've covered in the past, they're reported anywhere, they come out monthly as far as the CPI goes. And I've covered those little boxes, and I've done a great job, and I've highlighted at the time, you can predict with a pretty darn good degree of accuracy whether the CPI is going to come in above or below expectations. So you just look at the previous month. So this was the month of, what was that, June back here. Big drop. That was the first big drop. And then there was a big rise. So these little boxes show the beginning of the months. So what I'm doing right now is everything in this box. See this first red candle where my crosshairs are? That was the end of, I just wanted to, no, I need to do that. I had it like this. There it is. That was the end of May. This first green candle. So you can see right there, that was the end of May. May was a strong down month. In my opinion, probably the end of the corrective wave or correction in commodities. And so that's a big if, guys, if I'm right, and that marked the lows, and we're going to zigzag higher now, you're going to start to see that whole vicious cycle, negative feedback loop come into play. Commodity prices go up. Expectations for another Fed hike start to increase. Right now, the market has been pricing down rate cuts for a while, and then that is going to mean equity prices down. Again, doesn't matter if it's an actual hike from the Fed or a perceived hike by the markets because of inflation, but people will be watching this. So right now, you can, anybody can argue, you can say what you want. Oh, it's just another blip, another bounce in a downtrend, and that may be it. However, I've made the case recently that it's most likely more than that because we had buy signals. Put out trade ideas recently, including crude oil, natural gas, wheat, corn, those things, and they've all been rocketing pretty hard. So right now, most eyes just see another blip up, but I see a breakout, and if that breakout holds and these charts play out, big positive divergences down below as well. So that's something to watch, and that is my preferred scenario, guys. That whether tomorrow, next week we go down a little more or not, then we're going to work our way up here. You're going to see rising commodity prices, and the more that does play out, the more market participants are going to start to recognize, hey, guess what? We thought the Fed won the battle for inflation, but they didn't. Here it comes. It's starting to rear its ugly head, and it is more sticky than we thought. Some of my favorites. That's the thing. Wheat. Trade idea recently, and look, wheat, and this is, as far as food prices go, obviously wheat and corn, big thing. That's almost a 20% gain, up again today. We already took out the first target on the daily. I have targets I gave you on the 60 originally as well, T1, T2. So wheat continues to power up, as does corn and soybeans. And so we're seeing that inflationary aspect of food prices here. That's certainly going to translate. And so there's about almost a 20% rally in just in the last month or so. So my point is this is probably, or will, I'm sorry, not probably, this will to some degree or another. Again, you can look at DJP because it's more inclusive. It includes, industrial metal prices, precious metals. It includes energy, natural gas, oil. And when I go to this little box here, this shows you right now, so far for the month of June, which is still far from over, through today. And that yesterday we were up about 8%. That's a pretty good uptick. As of now, we're still up about a little over 6%. This box shows when the month ends. Right there, I have it on the July 3rd, which will be the first trading day. So I shift the box so we can include that candle. So we'll watch this. If in the next week or so we see this and we come down to here, then guess what? Well, there's where we closed the previous month. So at least from the commodity aspect of the CPI. Remember, this does not include rents or owner equivalent rents is what they look at, home prices, things like that. Services, obviously not in here either, because we don't have any real-time indicators on those. We can only kind of extrapolate what's going on there and look at more dated information. That's why I use this. So if we see that, then you know what? That helps support the case for maybe more upside in equities. If we see at the end of the month we close here or higher, we're going to have a pretty hot print on the CPI for the month of June. And that's going to strengthen the case for another rate hike, and the market's not going to like it. Okay, and then last but not least, because semis just got added as a new trade idea recently, with primary uptrend line here, comparable to the uptrend line on QQQ that we're targeting, and then a smaller, pretty steep bearish rising wedge. We look closely. What happened today is we took out, as I was covering last week, that was our next support level, S2, S1 being the trend line for support, that sell signal triggered there. And then we now broke S2, and you can see, as I always say, support once broken becomes resistance. And so this is textbook technical analysis. We broke it, and we didn't just meander on down through a solid red candle. It shows, as I was, well, you didn't get Friday's video because the audio wasn't recorded, but I said I would expect, I remember saying this in that video, that when that was taken out, you'd probably see a big red candle. I believe those are my words exactly, because you probably have a lot of stops set right there. So they took them all out. Then the dip buyers, as they will, when Pavlov rang his bell, the dogs salivated because they thought they were going to get fed, whether or not their food was there, because they were previously conditioned. So dip buyers will buy the dip. They did, but guess what? They were met with resistance. There were sellers waiting at that resistance level all day. These are 60-minute candles, and you can see it's a zone from 504.27 down to 503.32 roughly. And it also gives you a bit of a, when you look here, maybe on a 30-minute chart, maybe even go to a 15-minute chart. We'll leave it here on the 60. A bit of flagging looking action, bear flaggish. With that impulsive leg down, just like QQQ I showed you earlier. And so this is what we look for tomorrow. Break of that tomorrow. Want to see an impulsive break. That would probably take us down. And you can do, to measure out, get the measured target of a bear flag. You take the length of the flagpole. I really like to include just the impulsive part of it right there. You can go from that high. We had a little bit of consolidation, so that would be the max target, and then you add that to where it breaks down, and that would get us somewhere close to my first target there. And again, these are rough guides. When I do these measured targets, I give a higher weighting to my support levels. There's actually, I'm going to put this line right here right now. I'm not changing my targets. I'm just going to put the fact there was this little period of consolidation. So we'd probably get some buyers step in. You can see that consolidation sideways zone right here. Bing, 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 like ping pong. And then we broke out right there. So, and that would probably also mesh with the more conservative bear flag target. So 49.26. So let's just say you took this trade, you're in it. But you're in that mindset. We're only going to get a little quick pullback, and then we're going to new highs. You want to take quick profits. If you shorted this one at the initial sell signal, you would be, if you hit that 49.25, that's a 4% gain. Not bad for a quick swing trade. Everything's relative to the time frame. You might say, 4%. That means it went up 30, 40%. If you get 4% in a week, that's you're annualizing. That would be like 16%, not even compounded for the month. And this, you're talking hundreds of percent. So that's what swing trading is all about. Sometimes we get in, and again, that's not my target. This is a swing trade. I think we're coming down here, and all said and done, if you're not an active trader, don't try to get cute and game the little counter trend bounces along the way. All the zigs and zags, you're going to get close to 13%. If and when T2 is hit. And so therefore you can allow a little bit wider stop. But if you only want to go for that shallow target, again, that's still T1 down there, and that's that. Let me wrap it up here. So the takeaway is sell signals remain intact on the equity markets. The euro so far has hit and reversed off resistance where I expected it to. If that trend continues, those are the things I'm looking for. What starts to chip away at my case being short right now, especially for a deeper, longer term swing shorts, would be the euro taking out that level and clearly moving above it after this little pullback here. In other words, maybe the euro is bull flagging. So right here, you've got a little flag action. There's an impulsive leg up. And so that should be and would likely be bullish for gold, silver, and probably the equity markets. And it'll probably take us, stop us out of these current positions. So that's it. Gold, like I said, you still have on the 60-minute time frame divergent. We had divergence last on Friday. And we still have this marginal new low today. Now we broke support. So on one side, You could say, from the bearish point of view, well, support once broken becomes resistance, and it is. So when you get a break of support like that, if you want to go long gold, you don't go long right now. You wait till that level is solidly recovered, and then maybe you target back up to the top of this sideways trading range right here, or even more. Otherwise, as I like to say, support once broken becomes resistance, and that resistance could send us down here to the next big support level on gold, and it could even take out these divergences. So I think I made clear to you on Friday and again today, I have no horse in this race right now because I can see it kind of going either way. I just would prefer to hold off. So my positioning, got some commodities and equity in positions and things like that. I'm just standing on the side right now for the metals and waiting to, just because my convictions aren't so high, but that's just me. And then, crypto, I told you guys last week, probably get a bounce in the cryptos again, stand aside there. But, Ethereum, we hit that fourth target, and same when Bitcoin was at its price target. It's been a 31% bounce in just a couple of days. And so these, again, are things that at the very least said you might want to cover, take some profits, or at the very least lower stops. And I hope if you're still in this trade, you did that. I'm guessing a lot aren't in the trade because I'm not getting a lot of comments on this one. But there's a 37% rally to the highs today. We faded off that a little bit at the close, just since T3 was hit. Again, the case was made to either cover. There was positive divergence here on the 60-minute chart, and that's that. So reason I don't think anyone took this trade is it was a top call. We shorted the highs right there, even before it broke down. But like I said, that's really, really good support. And so, like I said, I thought the odds for a reaction were pretty good there. We've had a reaction. Now, when to re-enter? Let's let the dust settle. Well, you could have, we have some resistance here, resistance there. But, yeah, this one right now, I'll do some follow-ups on it. And again, if there's some of you interested in Bitcoin and Ethereum, let me know. Or anything else, anything that I'm not covering. I'm kind of narrowly focused right now on, commodities, most as far as equity markets, tech and the semis, and big tech in general, and then the energy complex. All right, I'm going to wrap it up here, get the video out to you guys, and we will pick it up tomorrow. This has been Randy Finney with Right Side of the Chart. Have a great day.